Welcome everybody to our Aminar today about the Main Street Lending Program. Thank you for joining us. Please post your questions in the Q&A only, and afterwards we will also invite you to raise your hand and chat. We'll be happy to take your questions one-on-one. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com, and later in the day we will also email a copy to participants. Briefly about myself, I am the founder and CEO of Multifunding. I'm an Inc. columnist. I've advised prior administrations as well as the Federal Reserve on the small business credit markets. I have a book out called The Growth Dilemma. And for EO friends out there, I'm a proud board member of EO Philadelphia. My lawyers asked me to read some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is a time for us to be thinking about and imagining what is next for our business. This is time to developing our strategy. Are we pivoting 5%, 50%, or 90%? This is the time to be examining our team and what our cash position is. This is a battle, and in a battle, cash is the ammunition. And in a battle, you want to be thinking how much cash will be required to get your business back up on stable footing. What is the best case and the worst case scenario? And where will the cash come from? And what does your future look like? And what options or opportunities do you want to take into consideration? This is the context I'd like to talk to you about the Main Street Lending Program. It has $600 billion allocated. Unfortunately, the program has taken off to a very, very slow start so far. It is in effect until December 31st, 2020, and it is comprised of 3 facilities: the new, the priority, and the expanded. Let's give some context. This is not an entitlement program like the PPP. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. Banks are up and running. There's a list of lenders on the Federal Reserve website that is not 100% complete and accurate, and the program has been extended until December 31st. Everything is moving at a snail's pace. You have to understand the motivation of lenders. If you have debt with an existing lender and your business is in trouble or has been hit by COVID-19, they have an incentive to help you get a Main Street loan if you're eligible, so it can help them protect their current liability with you. However, if you're looking for new lenders, new lenders are really only looking for strong credits and new banking relationships. You get one of these through a bank, a savings association, or credit union, and there are about 500 or 600 participating across the country. To be eligible, you need to be established prior to March 13th, 2020. You must meet at least one of the following 2 conditions. If you have more than 15,000 employees or 2019 annual revenue of $5 billion, you are too big to participate. And your business must be created or organized in the United States with significant operations in the United States. To be eligible for the US criteria, you must have at least 50% of your assets in the United States, annual net income generated in the United States, and annual net operating revenues are generated in the United States. Subsidiaries of foreign companies can apply, however, they have to attest that they will not send the money overseas to their parent. Eligible entities include partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Nonprofits can participate, although through a different program that we're not talking about today. Sole proprietorships are not eligible to participate. Ineligible borrowers include developers, landlords, and other types of speculative industries. If you are part of an affiliated group of companies, they can participate in only one Main Street facility, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. There are 3 facilities. Let's start by digging into the new and the priority. These share some attributes. They are secured or unsecured term loans. They have a 5-year maturity. Principal payment is deferred for 2 years and interest payments are deferred for 1 year. Principal payment at 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They are priced at an adjustable rate of LIBOR plus 3, and prepayment is permitted without penalty. The new facilities start as low as $250,000, and they go as high as $35 million. I see some folks are raising their hands. We're going to wait till the end, and we'll take all your questions at the end. How do you determine how much you are eligible for? So let's take an example for a new loan facility that they're based on a multiple of 4 times your 2019 EBITDA. So if a company had $500,000 worth of existing debt in 2019, the maximum they could get with $500,000 of EBITDA in 2019 in row 1, the maximum they could get would be 4 times that, or $2 million. If you subtract $500,000 of existing debt, that gives them a potential new money loan of $1.5 million. If that same company had $1.5 million of existing debt, their only potential new money loan they could get would be $500,000. What's important about these rights is that if you have existing lenders, they have to agree that in case of bankruptcy, they will share in proceeds with your Main Street lender. These loans can be secured or unsecured, depending on what other lenders you have and what you work out with your lender. And you aren't able to take out additional debt after you get the loan as long as they did not compromise the rights with your lender. Priority facilities go a little bigger. They start at $250 also, and they go as high as $50 million. These start with also an EBITDA of, these are based on an EBITDA multiple of 6 times instead of 4 times. So if you take in row 1, a company with 2019 EBITDA of $500,000, their not to exceed would be $3 million of that. That company had existing debt of $500,000, they have potential priority money of $2.5 million. If that same company in row 3 had $1.5 million worth of existing debt, they could get a potential priority money loan of $1.5 million. So important about these is you can refinance debt in good standing into one of these as long as the debt is not with the lender who's going to give you the Main Street loan. These lenders' rates have to be senior or par with all other lenders except for your mortgage. And they can be secured or unsecured depending what you're able to negotiate with your bank. The expanded facilities are much bigger. They start at $10 million and they go as high as $300 million. And this would be an expanded facility that you would work out with your existing bank. So as an example, in row 1, if you had $10 million of 2019 EBITDA, the not to exceed would be 6 times that, or $60 million. But if that company had $25 million worth of existing debt, they could get an expanded money facility of $35 million. These rights are similar. There's some, the tag along rights here are tag along of the same rights as you have with your existing lender. Otherwise, the loans are essentially the same, except the fees to get in are slightly lower. When you take one of these loans, you commit to refrain from paying your principal balance or any other loans with the proceeds of these loans, and that's it's part of a priority loan facility. You commit not to reduce your lines of credit or cancel them with your existing lenders, and you attest that you have a reasonable basis to believe that your business will not go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card in the ordinary course of business. You can take on additional debt as long as they do not conflict with the rights of your Main Street lender, and you can refinance maturing debt. There are certain certification and covenants that borrowers make, specifically related to compensation, stock repurchase, and capital distribution restrictions. There are exceptions for this for S corporations or other tax pass-through entities in order to cover tax obligations. While you have the loan, you agree, and for up to 12 months after the loan, you agree to a compensation cap. You agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree to cap your salary at that for while you have the loan and for 1 year thereafter. For those who earn more than $3 million, say you earned $6 million, you take the half between 3 and 6, which is 1.5, you add that to the 3, and your salary is capped at $4.5 million. While you have this loan, you agree to make reasonable efforts to retain your employees, but unlike PPP, this is more focused on retaining your company and less on your headcount. Your lender will calculate your EBITDA if it's a lender you've worked with before, exactly the same way they have done it for you before, or any proposed adjustments. If it's a new lender that you haven't worked with before, they will have to calculate your EBITDA and adjustments in a way they've done it for previously for other borrowers, just like you. Your debt will be calculated to include all debt at the date of your application. This could be from banks or non-bank lenders. And if you have an asset-based line secured by accounts receivable and inventory, your debt will be counted on the amount that you have borrowed against it, not the amount that you could borrow. How do you pick between the new, the priority, and the expanded? Well, to take row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt, they could get a new of 6, a priority of 14, or expanded of 14, and they have to choose whichever one that makes the most sense for them. Financing strategies like offense and defense. The Main Street Lending Program gives you the opportunity to think about it in both contexts. A company with a $3 million line of credit and $1 million drawn, as in one example, is planning on getting an MSLP for liquidity. They would rather not draw down their entire line, so they are trying to get this. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of over 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. Questions to ponder. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? Where will the cash come from? And as you look at the future, what opportunities do you wish to consider? That is the end of my prepared remarks. And now I'm going to invite any questions in the Q&A or to raise your hand in the chat, and we'll be happy to help you. And Hannah is absolutely here to facilitate.
There's a question in the Q&A. Are nonprofits permitted to apply for MSLP?
They are under a separate nonprofit program that I'm unfortunately not fair with the details of, but if you go to the Federal Reserve website, there's a whole program there for nonprofits for their own Main Street lending program. Any other questions, folks? Post in the Q&A, you can raise your hand, whatever you prefer. Questions are going once. Questions are going twice. There we go, got something.
What are your thoughts on Powell's comments?
Mike, and I see another question from Molly on that. I wish I knew. I have no idea. I don't know what they're going to do. They're going to do something, but I don't have a crystal ball about what they're going to do. I know they have to be under some kind of pressure because the program has had such a poor uptick, but I just don't know what they're going to do.
How much is the minimum EBITDA to qualify?
Technically, a company with like $45,000 of EBITDA could qualify. However, that would not really, if that would give you, and assuming you had no debt, that would give you a loan of about $250,000. However, if you want really anything under $1 million, the Main Street really is not much of a starter. Anything else?
Had the feds really only used 2% of the available funding so far, or did I get that wrong?
Got it wrong. It's 0.2%, Chris. Not 2%. That wouldn't be as bad. It's 10 times worse than that. It's 0.2%. Anything else, guys? Going once. Going twice. Oh, I've got something there. All right, guys. Unless anybody has anything else, we'll keep moving. And we thank you so much for your time.
Thank you, Ami.
Take care now. Bye-bye.